This short video focuses on the role of the public accountant in the global economy. This topic is foundational to auditing and assurance because it explains why public accountants exist, what services they provide, and how they contribute to trust, efficiency, and stability in capital markets. At its core, the public accounting profession exists to reduce information risk. The risk that financial and other information used for decision-making is inaccurate, incomplete, or misleading. By providing assurance and credibility, public accountants serve not only their clients, but also investors, creditors, regulators, and the broader public. In this chapter, we connect that purpose to core auditing concepts: assurance, independence, and the role of credible reporting in capital markets. Auditing is a systematic process of objectively obtaining and evaluating evidence about assertions regarding economic actions and events to determine the degree of correspondence between those assertions and established criteria, and then communicating the results to interested users. There are three key elements emphasized in auditing. First, information. Auditors do not audit companies themselves. They audit information, most commonly financial statements, but also internal controls, compliance reports, and other subject matter. Second, evidence. Evidence consists of underlying accounting records and other corroborating information used by the auditor to support conclusions. The quality and sufficiency of evidence are critical to audit reliability. Third, determining the degree of correspondence. Auditors assess how closely the information being examined conforms to suitable criteria, such as generally accepted accounting principles. Two professional requirements are essential throughout this process: the competence of the auditor and the independence of the auditor. Without technical competence, auditors cannot evaluate evidence appropriately. Without independence, their conclusions lack credibility for users of the report. Accounting versus auditing. Although closely related, accounting and auditing are distinct functions. Accounting involves recording, classifying, and summarizing economic events. Management is responsible for preparing the financial statements. Auditing, by contrast, is an independent evaluation of the information produced by accounting. Auditors do not create financial statements. They examine them and report on whether they are presented fairly in accordance with the applicable framework. This distinction highlights why auditors must have strong accounting knowledge while remaining independent of the accounting process itself. Independence allows auditors to function as objective evaluators rather than participants. Economic demand for auditing. To understand why auditing is demanded in the economy, consider the concept of information risk. Investors and lenders rely on financial information to make decisions, such as whether to invest in a company or extend credit. If that information is unreliable, they demand higher returns to compensate for the added risk. Audits reduce information risk by lending credibility to financial statements. This reduction in risk can lower a company's cost of capital, including interest rates on debt. Even a small reduction in interest rates can have a significant impact on earnings and cash flows. Financial misstatements arise for several reasons, including accidental errors, lack of knowledge of accounting principles, unintentional bias, and deliberate falsification, fraud. Auditors are not guarantors of business success, nor do they eliminate business risk. Instead, they provide reasonable assurance that financial statements are free of material misstatement, whether caused by error or fraud. In 1984, the Supreme Court described auditors as public watchdogs, emphasizing their obligation to independence and fidelity to the public trust. This phrase captures the profession's unique public responsibility. Assurance services and attestation. Auditing is part of a broader category known as assurance services. Assurance services are professional services that improve the quality of information for decision makers. Within assurance services, attestation services involve issuing reports on subject matter or assertions that are the responsibility of another party. Common attestation engagements include examinations, reviews, and agreed-upon procedures engagements. In an attestation engagement, management is responsible for the subject matter. The CPA evaluates that subject matter against suitable criteria, gathers evidence, and issues a report. Suitable criteria are standards developed by recognized bodies. For example, GAAP is the applicable financial reporting framework for financial statement audits in the United States, and the COSO framework provides widely used criteria for internal control audits. Audit of financial statements. In a financial statement audit, management prepares the financial statements using GAAP or another appropriate framework. The auditors then obtain sufficient appropriate audit evidence to support an opinion. The audit provides reasonable assurance, not absolute assurance. Auditors examine transactions, test controls, confirm balances, and evaluate estimates to determine whether the financial statements are fairly presented. Audit evidence addresses key management assertions, such as the existence and completeness of assets and liabilities, proper valuation, the accuracy and cutoff of revenues and expenses, and adequate disclosure in the notes to the financial statements. The final product of the audit is the auditor's report, which communicates the auditor's opinion to users. Credibility crisis and regulatory response. The early 2000s marked a major credibility crisis for the accounting profession, driven by high-profile failures such as Enron and WorldCom. In response, the Sarbanes-Oxley Act of 2002 was enacted. The Public Company Accounting Oversight Board, PCAOB, was established, and auditor oversight, independence rules, and internal control reporting requirements were strengthened. Later reforms, including the Dodd-Frank Act, further expanded regulatory oversight. Collectively, these events reshaped the profession and reinforced the auditor's public interest role. Types of audits. Audits can be classified into three main categories. Financial statement audits assess whether the financial statements are presented fairly, in all material respects, in accordance with the applicable financial reporting framework, for instance, GAAP. Compliance audits determine whether an entity is complying with specified requirements, such as laws and regulations, grant provisions, debt covenants, or contractual terms. Operational audits evaluate the efficiency, effectiveness, and economy of operations, often with the goal of improving performance. Integrated audits combine assurance on the financial statements with an audit of internal control over financial reporting, ICFR, a requirement for many public companies under PCAOB standards. Types of auditors. There are several types of auditors in the economy. Independent auditors, i.e., certified public accountants, provide assurance on the financial statements of public and private entities by performing financial statement audits in accordance with applicable professional standards. Internal auditors are employees or outsourced professionals who evaluate internal controls, risk management, governance, and operational efficiency, and they often conduct operational and compliance reviews. Government auditors, for example, auditors from the Government Accountability Office, GAO, and other federal, state, and local audit agencies, examine government agencies, programs, and contractors to assess financial reporting, compliance, and performance. Tax auditors, such as Internal Revenue Service, IRS revenue agents, and state tax examiners, examine tax returns and related records to determine compliance with tax laws and to verify reported tax liabilities. Each plays a distinct but complementary role in strengthening accountability, improving controls, and promoting transparency across the economy. Professional regulation and standard setting. The public accounting profession is regulated through a combination of professional and governmental bodies. The American Institute of Certified Public Accountants, AICPA, has traditionally played a central role in standard setting, research, continuing professional education, CPE, and self-regulation, particularly for non-public entities. For public companies, many standard setting and oversight responsibilities have shifted to the Securities and Exchange Commission, SEC, and the Public Company Accounting Oversight Board, PCAOB. Other key standard setters include a Financial Accounting Standards Board, FAZB, which establishes U.S. Generally Accepted Accounting Principles, GAAP, for non-governmental entities. B. Governmental Accounting Standards Board, GAZB, which sets standards for state and local governments. E. Federal Accounting Standards Advisory Board, FAYA-SAB, which sets standards for the federal government. D. International Federation of Accountants, IFAC, which influences international standards and promotes global convergence. The CPA profession. Becoming a certified public accountant requires meeting education and experience requirements, passing the uniform CPA examination, and obtaining licensure from a state board of accountancy. Beginning in 2024, the CPA exam consists of 3 core sections: AUD Auditing and Attestation, AR, Financial Accounting and Reporting, Reg, Regulation, plus 1 discipline selected by the candidate from BIR, Business Analysis and Reporting, ISC, Information Systems and Controls, TCP, Tax Compliance and Planning. State boards of accountancy issue CPA licenses, while NASBA coordinates among the states. Public accounting firms and career structure. Public accounting firms may be organized as sole proprietorships, partnerships, LLPs, LLCs, or professional corporations. Firms range in size from local firms to regional, national, and the Big Four. Certified public accountants serve clients from startups to global issuers. Within firms, services cluster into assurance, audit, tax, and advisory. Specialists include IT audit, valuation, cybersecurity, and data analytics. A typical firm structure includes staff, seniors, managers, and partners. Responsibilities increase with experience, culminating in partners who bear ultimate responsibility for audit quality and compliance with professional standards. Engagements are staffed in tiers. Interns and staff handle testing and documentation. Seniors run day-to-day fieldwork and coach the team. Managers plan, budget, and review. Senior managers oversee multiple engagements and complex judgments. Partners and principals accept clients and set audit strategy. They communicate with governance and sign the opinion. They are responsible for audit quality and compliance. Quality is system-wide. Independence and ethics. A firm's system of quality management. Engagement quality reviews on high-risk audits. External oversight includes PCAOB inspections for issuer audits and peer review for non-issuers. Careers progress with technical depth, leadership, industry specialization, rotations, secondments, and mobility across offices and service lines. At the top, the engagement partner is ultimately accountable for audit evidence and conclusions, and adherence to professional standards. Conclusion: public accountants play a vital role in the American economy by enhancing the credibility of information, reducing information risk, and supporting efficient capital markets. Their work serves not only individual clients, but society as a whole. Understanding this role is essential for appreciating why auditing standards, independence, and professional judgment matter, and why the public accountant is, ultimately, a guardian of trust in the economic system.